Thank you very much for being here, and thanks to the organizers for putting our paper in the session. This is joint work with Tom Wimberry, and it's called Financial Heterogeneity and the Investment Channel of Monetary Policy. So our goal in this project is to understand how financial frictions determine the investment channel of monetary policy. So given the rich heterogeneity that exists in the data in terms of financial positions across firms, a key question is which firms are the most responsive to monetary policy and why? Okay, so the answer to this question is theoretically ambiguous. On the one hand, we have that financial frictions make the marginal cost of investment higher, and as a consequence, financial frictions can dampen the response of investment to monetary policy for firms more severely affected by the frictions. Okay? On the other hand, given that monetary policy can alleviate the financial frictions, then they can amplify the response for firms more severely affected by the friction. Okay, so what I would say that this second view underlies the conventional wisdom that exists in the literature, mostly coming from applying the financial accelerator logic to a cross-section of firms. Okay? So in this paper, we are going to revisit this question by first providing new cross-sectional evidence in which firms respond the most to changes in monetary policy. And second, by constructing a heterogeneous firm new Keynesian model with financial frictions to interpret this evidence and to draw out some aggregate implications. Okay? So let me begin by summarizing our empirical work. So our empirical work combines monetary policy shocks identified with a high frequency event study approach with quarterly compute set outcomes. And our main result shows that firms with low leverage are the firms that respond the most in terms of investment to changes in monetary policy. Okay, and these differences add up and matter for the aggregate. So for instance, I'm going to show you that low leverage firms account for nearly 50% of less indebted firms account for nearly all the response of investment to monetary policy in our sample. Okay, and then a natural question is what drives these differences in leverage across firms. So what I'm going to try to convince you is that a key driver that we are identifying with leverage is default risk. Okay, so we find that low leverage firms tend to have higher credit ratings, and that higher rated firms respond themselves more to changes in monetary policy. Okay, so overall, this empirical evidence is going to point out to default risk being a key driver of how much firms respond to monetary policy, with low leverage, low risk firms being the ones that respond to more changes in monetary policy. Okay, then we are going to construct a model to interpret these facts. So our model basically what we do is to embed a standard corporate finance type of model into the dynamic new Keynesian framework. So in our model, firms are heterogeneous due to differences in productivity and in life cycle. And the key friction of the model is that firms are going to have access only to a source of external finance, are going to have access to bonds whose promised payments are not stay contingent, and they are not going to have commitment to repay them, and there is going to be a deadweight loss associated to default risk. Okay, so that's the main friction in the model. And then basically what's going to happen that monetary policy is going to stimulate investment through a combination of direct and indirect effect that I'm going to walk you through in detail. But the key here is going to be that firms with high default risk are going to face a higher marginal cost of investment associated with that default risk. And as a consequence, monetary policy is going to be dampened in terms of the response for this type of firms. Okay? The main, basically this is going to imply an important form of state dependence, which is that whenever the economy has a lot of firms with high default risk, the aggregate response of investment is going to be smaller to the shocks. And the main takeaway or punchline is going to be that basically default risk dampens the overall response of investment to monetary policy, which goes in a different direction than the conventional wisdom that I suggest you in the first slide. Right? Yes.
So, does the response of firms to the cost of capital is the same? Is just the cost of capital is high default firms will less sensitive to change in monetary policy, or do you have also difference in response to the cost of capital itself?
You mean in the data or in the model? Do you want to see? Actually, perhaps I will show that in detail a lot. Okay, so basically, in the data we are going to exploit. Just to give a short answer before, in the data we're going to exploit differential responses by these firm level characteristics, leverage and credit ratings, and then of course that in the model, then the default risk is going to be endogenously determined. Firms are going to face a price schedule and are going to choose their borrowing according to that. Okay, so in the model, they are going to, monetary policy is going to affect basically both the discounting of firms and it's going to shift the full bond price scale. Okay, but I'm going to explain that in detail. So if you still have that question, please bring it up again. Okay. Okay, so in the interest of time, I'm going to skip the literature unless there are particular questions. Okay, so let me start with our empirical evidence. I'm going to first describe the data sources, then I'm going to show you the empirical model and show you the results. Okay, so our sources are relatively standard, so we'll be brief describing them. So first we need some way of measuring monetary shock. There is a very well-known endogeneity problem that the actions that the Fed does is in response to changes in economic conditions. So what we do here is to use the event study approach that basically exploits the fact that the Federal Reserve actions come in discrete events, basically every 6 weeks, and that we have a measure of what the market exactly expects that the Fed is going to be doing. Okay? So we have these Fed fund future markets, and we can measure in a narrow window around FOMC announcement how much does the Fed surprise the market. So we're going to call whatever the Fed does that deviates from what the market is expecting, we're going to call that a monetary shock. Okay, so these shocks come at a high frequency. Our outcomes are quarterly, so what we do is to time aggregate these shocks. We aggregate them in a different way. So why do you do that? That's so lazy. So lazy in what sense?
When you have a model of 6 weeks and data collecting every quarter.
We do have data collected in every quarter. You mean in the theoretical model or in the
model?
In the empirical model, like I'm going to do two things in the empirical model.
The news come every 6 weeks.
Yes.
So why don't they come every 6 weeks in the model?
In the empirical model or in the theory?
In the theory, but then you construct data quarterly, which is the obvious thing to do.
Yes, we could do that. I mean, the thing. No, that's totally fine. So let me give you the answer. What we're doing is that our outcomes in the data come quarterly. Our main preferred specification, as I'm going to show you, come quarterly.
That's the data collecting, but the decision of monetary policy comes.
That's perfectly fine.
And if that's what you take it to be, you should do it like that.
Yes, we could do that. Fair. Okay. Now, an alternative that we do have just in terms of the data to clarify, we also have some high frequency regressions that we exploit to provide additional evidence as well. But let me concentrate again in what's our main empirical specification. So our outcomes come at a quarterly frequency. They are relatively standard, come from CompuStat. And our two main variables are investment, measured as a D-log of capital, a measure of the intrinsic margin of investment, and leverage that we're going to measure as debt to asset ratios. Okay? And then we merge these two data sets for the period 1990, which is the moment in which the Fed's fund market became liquid, until 2007, because we want to focus on conventional monetary policy. Okay, so we stop the sample in the Great Recession. Okay, so this is our empirical specification. We'll show you the empirical model, then I'm going to show you the results. Our empirical model has on the left-hand side our variable of interest, investment. On the right-hand side, we have our main interaction of interest here, which measures the monetary shock, denoted here by epsilon, and how the response of investment to monetary policy varies with firm leverage on the quarter before the monetary policy shock. Okay, so basically our coefficient of interest beta is going to be measuring how the semi-elasticity of investment with respect to monetary policy changes when we change leverage. Okay, and we then include firm level fixed effect to absorb permanent variations across firms. We include time sector fixed effect to compare firms within a quarter, within a sector, and a set of standard time varying firm level controls such as sales growth, size, fiscal quarter, etc. Okay, you had a question.
Is it real or nominal?
Is a nominal rate. Is it the change in the nominal rate?
So should we cover the real term instead of nominal term?
So the empirical evidence has shown a significantly high pass-through from these monetary shock to real rates, if you measure, for instance, tips, for instance. So we take this because it's going to be the object in the model, which is going to be the monetary policy variable. But in the data, it does have a high pass-through to real rates, which is, of course, what's going to be relevant. Okay?
Would leverage have an independent effect?
Yes, of course, we do have here controlling, we are controlling here, including leverage in a set of controls. Okay? Yes. Yes, absolutely. Yes.
Would there such things as an implication of inflation response to this monetary shock? What is that?
Sorry?
What is the inflation response to this monetary shock?
The inflation response, we are not showing that, but there is an empirical paper, for instance, Nakamura have one showing that the inflation response to the shock is pretty mild. Okay, so that.
But in the model, eventually.
Oh, no, in the model, we are going to have a Taylor rule, and it's going to be, you are going to have a shock to a Taylor rule, and a monetary authority is going to respond according to that Taylor rule to the shock.
So are you going to match jointly the response of this leverage of the investment and inflation?
Yes.
Only?
So in the we're going to try to run this regression coming from data generated from the model, if you're asking for that mapping. All right?
I guess I'm asking, like, are you going to test the implication for inflation in a theoretical model with data?
In the model, we are going to we are going to assume a given response from the Federal Reserve, which is going to be a standard, a Taylor rule. And we are not going to, we're going to have an endogenous response coming in the model for that. So I don't know what you're saying about testing that. So do you mean if in the data we're going to look to all responses? We are not doing that basically because we are not the first to identify monetary policy shocks like this. And papers that have studied monetary policy shocks like this have shown that the response of inflation is pretty mild. Okay, so we're going to be taking this measure of monetary shocks. Does that answer your question? Okay, and then we are going to cluster errors two ways, at the firm level and at the quarter level. Okay, so this table shows our main empirical results. We are going to have different model specifications in the columns, different variables in the rows. And let me jump directly to our second column, which is our preferred specification. Let me clarify two things before telling you the results, which is first, that we flip the monetary policy shock such that an expansion has a positive sign. Okay, so we flip the sign of the monetary policy shock. Even if an expansion is a decreasing rates, so an expansion has a positive sign. And second, we standardize leverage. So these can be interpreted in terms of standard deviation leverage in the whole cross-section of firms in the whole sample. Okay, so our main coefficient of interest is beta that I was showing you in the previous regression, shows that having one standard higher deviation of leverage than the mean reduces the response of investment to interest rate by 0.73.
Can I just let us say, if Mr. Bernanke coughs his average cough,
If?
Mr. Bernanke coughs his average cough, like his average deviation,
Yes.
whatever that is another way. Output changes by how much?
So, well, you might wonder what's the main effect of monetary policy. So what would you should you be comparing this?
I want the units that your thing says.
Yeah, so let me kind of to compare, if you want the main effect, we have done investment here for our sample. This indicates that, so for our main specification, basically, the reason why I'm showing it in a different column is that we drop here the time fixed effect that we're absorbing anything that is at the time level. But now we can estimate an average effect of monetary policy. So this coefficient indicates that a 1% decrease in rates, in interest rates, increases the investment rate by 1.4%. That's at least what I have to say. Go ahead. Yes.
So your notion of a shock
Mm-hmm.
is the bad mode, is the average deviation of the mode of the monetary policy makers from the market's expectation of what they would
Yes.
do. They're saying just the approachiness of the day. There's an average absolute value of the approachiness.
The standard deviation of the shock, you mean, is 12%, 12 basis points.
So on average, yes, I'm saying I don't know what the standard deviation is in terms of average error. I think it's easy to
The mean is around 0 of these shocks.
well,
But
the mean has to be zero. I suppose. There is
well,
It's an average non-zero. If you take the absolute value of the deviation, what's the average?
So I don't have that. I can show you some statistics of the shock. The standard deviation is 12 basis points. It goes kind of the bigger shock we have here is an expansionary shock of 46
Let's say it's
basis
5
point.
basis points. So that's the average moodiness of this guy.
Mm-hmm.
And what your regression say about the changes in real variables? What did your regression say?
Well, I mean, here we're saying for each percent change in rates, the investment rates respond by 1.4%.
And you can change the units. Let's go back to the units.
You can translate it yourself to whatever you prefer.
5 basis points of the randomness residual that these guys have. That's 5 basis points. So that would be 5% of the number you get here.
Yes.
And that's
If you want the,
is 1.4 what?
Is 1.4% per each percentage change in rates. So if I change the rate from 1 to 2%, that should decrease investment by the investment rate by 1.4%.
So the average deviation like 5 basis points, so it'll be like 8 or 7 or 8 basis points change in real investment. That would explain.
Yes. Okay. But here we are not focusing mostly on this effect. What we want to transmit the most is that basically having one higher standard deviation of leverage eliminates roughly half of the main effect of monetary policy on investment. Okay? So this indicates that firms with higher leverage dampen their response relative to the mean, and that this is economically significant in terms of its magnitude. All right? So another way of assessing the relevance of these is kind of having a more time series evidence. So what we did for this was basically to go to each quarter, sort firms by leverage, and construct 10 deciles of investment for each 10 deciles of firms sorted by leverage. We average out investment for all the firms in a given decile, and we have a time series of investment for each decile of leverage. Okay, so we have here those firms that have less leverage in our sample. We have here those that have more leverage in our sample. You can see two things coming from here. So first, the pattern that firms with lower leverage respond more to changes in monetary policy. And second, that basically after the 60th percentile of leverage, firms are basically unresponsive. Okay, so this is what I mean by low leverage accounting for nearly all the response of aggregate investment to monetary policy in our sample. Okay.
I wonder if the response could be asymmetric.
Yes, so that's a good question. So we have explore that. We are finding that basically expansions are driving most of the results, but we are not making a big deal about that because basically the confidence intervals, once we distinguish between these type of shocks, these two type of responses are quite wide, so we are not focusing on that. So we have explored it, but we are not focusing on that. But if you want to know how the result looks like, yes, it's only driven by expansion in the data, all right? Which could make sense from the theory. But we are not going to be focusing on that.
Does it mean that they just eat the shock or something? Or they actually finance themselves through equity or something?
Right, no, so we have all these we have the response of external finance, and it's consistent with this. So in our model, firms are going to invest more because they are going to borrow more, and this is also what we see in the data, okay? Okay, so now the key question is, of course, we are not claiming here that we have exogenous variation in leverage, okay? And so that's why we are labeling this empirical evidence as descriptive empirical evidence. Nonetheless, we have tried to dig further into the data to try to understand what's driving our responses. Okay, so in our model, basically, the main reason why firms with low leverage respond more is because these firms have low default risk, and as a consequence, they do not face such a steep marginal cost curve. Now, alternative explanations that could be provided in the data, you could say, well, wait, but if basically firms here have different collateralizability in terms of assets, you could have that firms that have a lot of collateral borrow a lot, and that's basically capturing kind of the opposite interpretation of leverage. So we do not think that this is the main driver of the results in our data. First, because we are comparing firms within a given sector, and most of the collateralizability of assets is within a sector. But even if we do at the mean of leverage at the firm level, and we only exploit differences in leverage after with the mean, we also find if something even stronger results than those that I showed. Okay, so we don't think that collateralizability on assets is driving our results. Another interpretation could be, well, leverage is just capturing another covariate that we have. So we have analyzed many covariates that you can think, the typical sales growth, size, future sales, so on and so forth. We haven't found that any of these covariates absorbs the variation of leverage. Many of these covariates are not even significant in terms of the interaction, but more importantly, they do not absorb the variation that we are identifying. Okay, so another thing that you could say, well, those are observables. You could have unobservable factors driving both variation of leverage and variation in investment. If that's the case, then if we instrument current leverage with previous leverage, then our coefficient should dampen. Okay, so we tested that with an IV strategy using previous leverage as an instrument for current leverage, 4 quarters ahead, 8 quarters ahead, 4 quarters ago and 8 quarters ago. And we find that the result is something also stronger than those that we find. So what do we think that drives these heterogeneous responses in terms of leverage? Well, we think that the evidence points out to default risk as being the main driver. Okay? And this argument basically consists on 2 features that we find in the data. First, that low leverage firms tend to have better credit ratings. Second, that highly rated firms are themselves more responsive to changes in monetary policy. So this is a picture to show you the first of the 2 statements that I make. So here we have on the horizontal axis different credit ratings. So we have, this is in numbers, but a double B is around 8 here. And we have here densities across different parts of the distribution of leverage. Okay, so we split the distribution of leverage into 3/3. We find that firms with low leverage and medium leverage tend to be located in this region. Okay, indicating that firms with low and medium leverage tend to have higher credit ratings. We find that firms with high leverage tend to be located to this region, showing that high leverage firms tend to have poor credit ratings. Okay, so the market assessing risk has the same interpretation as this, and in fact, this is also true in conditioning by firm characteristics, and leverage is one of the main predictors of credit rating in our sample.
Each of those lines adds 100?
Yes, so this adds, everything adds to 100.
Oh, everything else.
Yes, okay. All right, so then we also tested whether highly rated firms respond the most. So we construct an indicator variable that denotes if a given firm or a given quarter has a credit rating above AA, and we find a significantly higher response of highly rated firms to these changes in monetary policy. Okay, and even if we combine these 2, we find that both go into the same direction. Low leverage and high credit ratings, firms responding more to changes in monetary policy. Okay, so then we conducted a set of robustness to this finding. So first we find basically here we tested kind of additional different if other cyclical variables are driving our results. So we do not find any aggregate variables that absorb the variation that we are having. So here there were a couple of questions about kind of which are the rates that the firm perceived. So here we instrument changes in the Fed fund rates or changes in corporate spreads with our high frequency monetary shocks, and we found consistent result to that. We also measure leverage in different ways, and we also measure investment in different ways, not only an intensive margin, also an extensive margin, measuring the investment of leverage. Okay, so overall, there is a strong evidence pointing out to the fact that low leverage slash high credit ratings firms are the ones that respond the more to changes in monetary policy.
Is it true if you look at kind of longer cumulative effects?
So we also analyze dynamics. So we find that most of the effect comes on impact, and that's what I'm showing you here, kind of the impact result of this. The dynamics basically dies out. Now, just to keep in mind, the object that we are interested in, which is the differential response across firms, is a different object that the one you might have in mind, coming from the ham-shaped responses of aggregate investment. So it's not inconsistent with those findings.
Okay, so maybe it's AAA firms have like credit lines they can immediately tap into, but the high leverage firms takes time for them to get credit.
Yeah, so that's yeah. I can show you the dynamics. Basically, it's most of the effects come on impact. Okay, I can show you if you want. So these are kind of these are Jordan's study of projections, which each quarters ahead, and each here measuring the quarters ahead, and you find that most of the intensity and extensity margin response come on impact. All right? All right. So let me now go to the model. So let me tell you again what's the objective of the model. Yes. Yes. That's what you were asking. Yes. So what's the objective of the model? The objective of the model is now to interpret this data and to draw out some aggregate implications. Okay, so we want to interpret why is it the case, or if it makes sense, that low leverage firms in a standard corporate finance type of model are the ones that respond the more to changes in monetary policy. Okay, so the spirit of our exercise is to embed a standard corporate finance type of model into a New Keynesian framework and analyze how different firms respond to changes in monetary policy, and we're going to compare that with the data. Yes?
You say something like this is a natural outcome of your middle of the road internal.
Well, right, so mostly, I'm going to describe another model in detail. The most interesting part of the model is going to be this heterogeneous firm model with financial frictions. That's going to be the core, okay? And then there's going to be a New Keynesian block, but yes. So we're kind of jointly analyzing this.
And there's nothing mysterious in this outcome, is that what you're trying to say?
Yes, I'm going to show you that, in fact, a calibrated model, so we construct a model, we calibrate it, and we find consistent results with those of the data.
So in a way you could say some words, what's the logic under which the model generates those features?
Yes, exactly. That's exactly what I'm going. That's exactly what I'm going to try to do. Thank you. All right? Our model has 3 blocks, and I'm going to spend most of my time explaining our main interesting block. So what's our main interesting block? We have a block of investment of heterogeneous firm with financial frictions. So firms are going to borrow to invest and face default risk. And there are going to be some intermediaries lending to these firms and offer them a bond price scale. Okay, and then there are going to be 2 blocks of the model, which are going to be completely standard. So first we want a model in which there is a monetary authority doing something that affects relative prices. Okay, that was coming to your question. So here we are going to be fully standard. So what we're going to do to keep the model tractable is to assume that these firms sell their output in a competitive market to some retailers. These retailers have some pricing frictions. We're going to assume just Rothenberg prices for simplicity. Then these retailers are going to sell their output to a final good producer that is going to combine them and sell the final good to the household. Okay, there's going to be a monetary authority following a general rule that is going to deliver us a Phillips curve linking real and monetary variables in the model. And then we are going to have capital goods producer that brings us a price of capital that moves over time, which is kind of a central part of the, let's say, financial accelerator literature, has this price of capital moving around. Okay, so that's the reason why we want to have kind of the price of capital as an important object. And finally, there's going to be a representative household that owns the firm and supplies labor. Okay, but this is the part of the model that I'm mainly going to be describing. Okay, so how does a firm look like in terms of preferences and technologies? So firms maximize their lifetime discounted dividends transferred to the households, okay, using the household stochastic discount factor here. They have access to upper action technology with decreasing return to scale using capital and leverage input, and face 2 idiosyncratic shocks. So they face this Z here, which is a persistent shock to their productivity, and they face this omega here, which is a shock to the quality of capital. So what does a shock to the quality of capital means? This is the capital accumulation technology that a firm has. It indicates that next period's capital stock for a given firm is going to be depreciated effective units of capital. So look at the shock to the quality of capital basically determines what are my effective units of capital that I have, plus whatever the firm invests. Okay? So this is basically the shock to the quality of capital is going to be an IID shock that the firms face every period. And it's an important shock kind of for technical reasons, so all the firms face really default risk. Okay, that's the reason why we introduce the shock to the quality of capital. Otherwise, capital is such a safe asset that most of the firms are not facing default risk. Okay, so that's the reason why we picked to introduce this additional shock. Okay. Now, in terms of financial frictions, yes, I'm going to describe. So the firm enters a period with 4 states: idiosyncratic productivity, realization to the quality of the shock to the quality of capital, its debt, and its capital. But let me describe you the environment first, and then I go to the states. Okay, so just to end up describing the environment, I want to say what are the financial instruments that the firm has access to in order to finance investment. So the firm has access to basically these one-period bonds that lacks commitment to repay. So these are bonds whose promise payment is not state contingent. And there is a deadweight loss in default. Okay, so the lenders do not recover the whole firm, but just recover a fraction of the capital of the existing firm. And as a consequence, these firms are going to face a bond price schedule in Q, which is going to reflect the default risk of the firm. In terms of equity, we are going to go simple, and we are going to just assume that firms cannot raise equity, and as a consequence, dividends cannot be negative. All right. As usual, you need frictions on the two sides, on the equity side and on the debt side, in order for financial frictions.
The way this works is that these guys, our firms are average, and then overnight they get this omega thing, their capital is wiped out, there's nothing they can do.
Right, so yes.
It's a borrow.
Yes.
And they will not keep a lot of equity. How do you make sure, how do you prevent them from keeping a lot of equity?
Well, they are going to die out over time. That's going to be kind of the technical assumption in order for firms not to accumulate enough wealth over time. We're going to have exogenous exit on the top of the endogenous exit due to default.
The exit doesn't, they're not liquidated, so the capital dies with them, so they want to give.
You give the capital back to the household and a new firm enters. Okay, so there's a one firm out, one firm in. Okay, so and firms start young again. So as usual in all the models of financial frictions, as you are very well saying, you need to have something for firms not to accumulate such much wealth that they run out of the financial frictions. There are kind of 2 or 3 ways of doing it. We did one which we can discipline well with the data, which is this exit rate of firms.
But it's just because the omega is multiplicative on K. I mean, no matter how much you save, you could wake up with 0 tomorrow if omega is small enough. So
Yes.
you can't smooth out blowing out capital.
Have enough equity.
No, but if omega is 0.01.
No, but he's right that basically a firm can grow enough, so can have such a wealth over time that basically never faces default risk, and that's going to be a share of firms in our population. Okay, so it's going to be 3% of the firms are going to become, as I'm going to show you, are going to become neoclassical firms over time. But just the exit rate makes that fraction to be very small. All right, so now here I will show you the states of the firm and the recursive problem. So a firm enters a period with you have a question? A firm enters a period with 4 states. It's idiosyncratic productivity, shock to the quality of capital, the capital stock that the firm has, and the amount to repay B. All right? So what are the sequence of decisions taken by the firm? So the first thing that happens to the firm is not a decision. It's just an IID shock that makes the firm to exit with a given IID probability. Okay? This is a shock that hits a firm on the head. The firm disappears, and that's for the technical reasons that I was describing before. It's something that we can discipline very well with the data. Okay. Second thing that the firm decides is whether to repay or not. Okay, so if the firm decides to default, it's going to have a value of 0. And if it continues, it will repay its debt and pay a fixed operating cost here on the side. Okay. Third thing that the firm decides is, given its productivity, given its quality of capital, given its capital stock, how many hours the firms want to pick. So this is a very simple static problem in terms of maximizing revenues or hours worked. And then the firm, the last thing that decides is how much to invest and how much to borrow. Okay, so the firm, this is the recursive problem of the firm. So the period flow here are dividends denoted here. First, the revenue minus debt repayment plus the depreciated capital that has a price of Q minus whatever capital the firm wants to buy for the next period plus whatever borrowing the firm picks. So the firm picks B prime as a promised repayment tomorrow and faces this bond price scale Q that depends on the firm choices and on the current productivity that I'm going to describe you in a minute. All right? And then the firm has the following continuation value that takes into account all the possible things that can happen to the firm tomorrow, namely exit, default, or choosing again to continue and to invest and borrow. All right? Okay, so how is this bond price scale determined? So we have competitive financial intermediaries that basically use a household stochastic discount factor to price the bonds, and they are going to basically have two possible outcomes of the firm. The firm repaying the bond, so the financial intermediary receives 1 over pi, or the firm defaults, and as a consequence, the financial intermediary records a fraction alpha of the market value of capital, okay? As long as that's less than 1, right? So that's how the bond price scale is determined by this firm, very standard in this dimension, okay? Okay, and then as we have exit due to exogenous exit shocks and due to default, we also want to have entry. So what we do is a very simple entry process. So for each firm that goes out, we have one firm in, and we draw the productivity of the firm from a shifted distribution to account for the fact that firms that enter typically have lower productivity and are more volatile in terms of their productivity. So this is a distribution from which new entrants draw their initial productivity. Okay, and then they are endowed with a given initial capital stock that is going to be another object of the calibration.
The financial intermediaries, do they serve different firms? And they serve different firms so they can...
Yes, exactly. So everything idiosyncratic is perfectly diversified. Okay, so yes. Yes, exactly.
In your composite data, how often happens that the firm default?
So we match actually. So when we wanna when we match the default rate that we're going to match is 3%. That's not composite, but it's going to be a broader set of firms. So when we calibrate the model, we are not going to pretend that composite is the whole economy. Okay, so we're going to try to calibrate the model to the whole economy, and then to compare it to the data, we're going to pick a subsample of our model that is similar in our view to composite. Okay?
Have you have any evidence about the response of entry and exit to the monetary policy shock identified?
Of entry and exit. So here that's not the main margin of action, right? So this is kind of entry and exit is first of all, it's not a part of the propagation in the sense that we also always have the same number of firms. And then what matters the most is how these firms differ in terms of their states. So that's going to... That's by assumption, yeah. So we want to abstract from the... Yeah, exactly. So but that's just...
That's what the asset of him. He asks you what are the equilibrium properties of entry and exit, and the answer is none by assumption.
Yes.
That wasn't clear before.
Sorry, yeah. Thank you. All right, so let me now zoom back again and tell you what an equilibrium looks like. So we have this heterogeneous firm model choosing investment and borrowing. Then we have financial intermediaries pricing default risk. Then we have entry and exit with this shifted distribution. And then I'm not going to enter into the details of the New Keynesian part and the household part just because it's very standard. Yes. Yes. Mm-hmm.
There are two ways to think of the problem. One of them is that things look better, like the returns on investment look higher.
Yes.
You're saying only the firms in good standing can able to capitalize on that.
That's exactly what I'm going.
But I said the other one, which is debt is cheaper.
Yes. So I'm going to
You said nothing about debt is cheaper to the existingly indebted firms.
I'm going exactly to that. I want to define an equilibrium first, but I'm going exactly to that direction. Okay, so you read my mind in terms of, you don't like the channels, perhaps, wording, but that's exactly what I'm going, okay? So just to wrap up the equilibrium, so we have these retailers and final goods producer generating a Phillips curve, the monetary authority following a Taylor rule, capital goods producer, and the household that supply labor and determine the stochastic discount factor.
So
all right?
Are the countercyclical markets here affecting further results? I mean, is it, how much of the fact that like profits are falling in response to a positive shock?
So let me show you exactly. Basically, that's going to be one of our components. Is going to be that this firm that is investing is going to have a shift in its relative price at which it sells its output, and that's going to be part of the mechanism. All right, but
so saying that this all happened because of the insane property of the Keynesian model that in good times firms lose money.
I want to know if that's...
No, but that's
I wasn't sure this was the question.
No, that's a good point. So just to clarify that, so that our models do not, our investment firms do not have that property here in the sense that the price at which they'll sell the output increases. Okay, but I'm going to show you that in detail. All right. we have the retailers, which are the ones that behave as you have in mind. Okay, so let me show you, before I enter into describing the different channels through which firms respond, let me kind of briefly summarize how does the state of the firm look like. So we have here current productivity and cash on hand of the firm. And the problem can be collapsed into these states for a firm. So what do I mean by cash on hand? Revenues minus wage payment minus repayment, fixed cost, and whatever the firm has when it enters the state. Okay, so this significantly simplifies the problem. So we have basically three types of firms. We have firms with a cutoff of cash on hand by which they default. So firms here in this model defaults due to feasibility, namely that there is no level of borrowing and investment next period such that they can satisfy the non-negative dividend constraint. So that happens for enough low values of cash on hand. And we have this blue line here denoting when a firm becomes a Modigliani-Miller firm, a neoclassical firm. So those firms basically can afford the optimal level of capital that they can have in every state without running any default risk. And these are neoclassical firms. But 97% of the firms are going to be here in the middle. So these are firms that are going to be always against their non-negative dividend constraint. So they are going to have the very interesting property that the capital that they buy is going to come from their cash on hand and from whatever borrowing they do.
So it's a zero dividend firm.
97% of the income, yes. Yes, we're thinking broadly as firms that face some sort of financial constraint affecting their allocation. In our specific model that we pick, for simplicity, this firm pays zero dividend. Dollar in the firm is always more valuable. Okay, so.
Will you accomplish that? What's the number? Since that's the relevant comparison.
Of the
Of zero dividend firms.
I don't remember that number. Okay. But just to be sure, the non-negative dividend constraint is a technical assumption that simplifies us the problem and allows us to express in terms of cash on hand as a single state more than something that we believe that the fact that a firm is constrained. I mean, we could relax this, for instance, assuming that there is some proportional cost of raising equity, so you could have there more movements in the dividend. So so this is more of a technical assumption than something that we believe that here we should map these to the share of firms that do not pay dividend. Okay, so basically we have two types of firms: risky constraint and risk-free constraint firm. These Euler equations describe basically the optimal choice of capital and borrowing for these two types of firms. So here we have on the first line the marginal cost of acquiring capital. Here we have the marginal benefit of capital. Okay, so what does this have? So the first term here captures the effective cost per unit of capital, which has the price of capital and that has how much the interest rate the firm saves in terms of interest payments for providing an additional unit of capital. The second term here is the marginal borrowing cost, okay, the spread that the firm faces. And this term here that measures how much does the borrowing costs are affected by the fact that the firm is borrowing more, okay, the elasticity of the bond price scale relative to investment. There's a third term here that I'm going to ignore because it's quantitatively small, basically describe how much does the value of the firm is affected by changes in the threshold at which the firm defaults. And then here in the second line we have the marginal benefit of capital, which has here the marginal revenue product of capital, which is coming from the derivative of the revenues that the firm obtains with respect to capital. So as usual, the firm faces here the marginal product of capital net of labor cost and the depreciated value of capital tomorrow. So this is a relative price that I was basically describing you that is going to be a key part of the mechanism, okay? And then we have a term measuring here the fact that firms value more capital if it pays out in states in which it values more cash. Okay, so this lambda is the Lagrange multiplier with respect to the non-negative dividend constraint. Okay, so let me now try to briefly summarize what are the ways in which a firm responds to monetary policy shock, and we draw this in a very simple diagram. Okay, so what I'm going to be considering here is an MIT expansionary shock to monetary policy and see how these different firms respond to changes in monetary policy. So I'm going to show you two types of firms, basically a firm that is currently not paying default risk and a firm that is currently paying default risk. So here we have the decreasing curve is the marginal benefit of the firm that is decreasing due to decreasing return to scale of the firm. And here the marginal cost curve has this flat region in which the firm only has as marginal cost the price of capital, and an upward sloping region, which is whenever the firm incurs into default risk. Okay, so this is the initial moment of the firm. What does a monetary policy shock do? So the first thing that the monetary policy shock do is to shift the marginal benefit curve due to the fact that the firm now values more the future due to the interest rate being lower or the discount rate being lower. Okay, so that's with the MIT shock, that's the household discount factor, and the firm's values more the future, therefore shifts the marginal benefit curve. In addition to that, there are indirect effects from the fact that monetary policy affects the price at which these firms sell its output, the wages that the firm pays to the workers, and the price of capital. Okay, so we consider all these as additional indirect effects of monetary policy.
But is there a financing prices in there?
So here, this is the risk-free firm. So this firm, we draw it on purpose such that basically there is a term here capturing the possibility that tomorrow the firm faces some constraint, but today the firm is not facing any default risk. Okay, so we're shutting down here by construction the risk of these firms.
There can be firms that have debt but no risk.
Exactly, they have firm but no risk. So we are considering a firm that has enough cash to finance investment without risk, but doesn't have enough cash in order for financial constraint not to be relevant whatsoever. Okay, so it's a...
I'm asking about a different thing. Are there any firms that have debt but no risk?
Yes, these are the type of firms that we have here.
They will have debt.
Yes, they will have
If
that.
the debt is long term, they have to do better because the interest rate that they have to pay
Yes.
went down. Where is that debt?
Well, it is collapsed into here. So this combines basically the two Euler equations, the Euler equation for debt and the Euler equation for capital.
No, because isn't there like a, maybe the way, if I have some nominal long-term debt,
This is short-term debt though. It's one period debt.
you're saying you're preventing them from gaining anything from monetary policy
Yeah.
by assumption
Yes,
also.
yes. It is short-term debt. That's another thing we can
You
expand.
say from the beginning that says because of that irrelevance of the firms that are leveraged, you're going to ignore any possibility that the financial burden that they have to pay gains from monetary policy. Because you're hiding it now in a way that...
No, I'm not hiding it.
No, you're hiding now the fact that you take in that the data tells you that this is not very important.
Well, it is important to affect allocations. We would have an additional channel if we will have long-term debt. Nonetheless, in the data, we have split short-term and long-term debt. Both are kind of equally relevant to determine the firm's decision. So it's not that in the data, this is driven by short-term, long-term debt. Okay?
Monetary policy here doesn't redistribute resources from borrowers to lenders.
Yes.
If you had it, they would be improving the fate of highly leveraged firms.
That's going to happen too. So let me show you the highly levered firms. So what happens to the highly levered firm? The highly levered firm now faces a marginal cost which is upward sloping, reflecting its default risk. Okay, so first this firm has the same shifts in the marginal cost and marginal benefit curve as the previous firm. Okay, but in addition to that, basically what you want here is that these firms now have more cash. Basically, okay, they have more resources if you have an expansionary monetary policy shock. So the location of this point shifts. And also now the steepness of this marginal curve also shifts because now risk is lower and the collateral of these firms is more valuable. Okay, so basically what we want to transmit here is that this is what I mean by being theoretically ambiguous, which are the firms that respond the most. Okay, so in principle, it could happen that low risk firms respond the more or high risk firms respond the more. This is a quantitative question. So if in 1 minute now, I have to show you the quantitative result. Yeah. I'm going to try my best. But so we calibrated this model seriously to match investment rates, financial behavior of the firm, and the growth rates. So we did a very extensive job to try to analyze the life cycle of the firms and the properties of the firms that if I will have time, I will explain to you more. Basically, now what we kind of do is kind of an MIT shock now in the model, which is going to be this unexpected expansionary shock to the Taylor rule and study the transition back again to the steady state. So basically this figure shows, yes?
So here, this interest rate move is persistent over time, but in the empirical part of the show, this is more like a one-time shock, right?
Yes, that's true.
So it's not really the same kind of shock. And according to Victor's question here, really it's not a one-time shock, it's persistent. So we do have this benefit if we for some time, because in the future also the interest rate can be lower.
Yes, that's fair enough. So there's a lot of the persistence here comes from all the endogenous response. Okay, so it's but yes, I mean I take both as things that.
Manage your last 0 minutes.
Okay, so my last 0 minutes. So let me show you mostly one thing, which is that we run in our model the same regressions as we run in the data, and we basically find here low leverage firms being more responsive to changes in monetary policy. These low leverage firms are basically firms that have high cash on hand. And basically what happens here is that whenever there is an expansion in monetary policy shock, firms finance their investment with borrowing. But basically these low cash firms have a higher marginal cost of borrowing, and as a consequence they do not increase borrowing so much. Okay, that's the reason why in our model firms that have high leverage, have high default risk, they face this steeper marginal cost curve and they do not borrow as much. Okay, and last word, basically this provides a novel form of state dependency, which is that the distribution of risk in the economy matters for the aggregate effect of monetary policy. Okay, so we did this kind of as a back of the envelope calculation in which we shifted the initial distribution with which we do the shock. So basically when we shift the cash on hand of firms in the economy, for instance, if the cash on hand of the economies will be half of that in the steady state, the response of investment will be 25% lower. Okay, so the more firms you have with high default risk, the less is the response of monetary policy, and that's our main conclusion. Okay, default risk dampens the response of investment to monetary policy, and this is both in the data and in the model.
Okay, thanks very much.
Thank you.